Silicon Valley Bank, the rise and fall of a Silicon Valley superstar. Hi folks, welcome to RJA Impact. Today we're going to be looking at the ongoing story of the collapse of a bank, not just in isolation, but whether its troubles are the tip of a proverbial iceberg of pain weighting the wider US and world economy. If you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. John Paul Getty. I bet taxpayers remember providing more than $812 billion to Citigroup and Bank of America, two Wall Street banks in 2009 to bail them out during the 2008 financial crisis. Taxpayers remember that generosity, big banks evidently don't. John Kennedy. Two quotes, one perhaps more humorous than the other, but both with a serious message that perhaps summarise the position we find ourselves in today with the apparent bailout of the crypto-fueled banks Silicon Valley, Silvergate and Signature. We're focusing here on the first of these to present troubles last week, a Silicon Valley Bank. Founded in 1983, its rise since then has been stellar, being the 16th largest US bank last year, being named in the best banks of the year by Forbes for at least 5 years in a row, and controlling over $200 billion of assets. Despite this, we saw in the space of only a couple of weeks a panic that is being claimed as the worst since the financial meltdown in 2008. The FDIC originally stepped in and tried to reassure customers, making them aware that up to $250,000 would be made available to them after the bank itself stopped allowing withdrawals as it ran out of ready funds to meet the exponentially growing requests. This just was not enough. Companies, including many Silicon Valley startups, could not find enough money to meet payrolls, and local banks have seen their share prices collapse, and talk about this being the start of the next big credit crunch abound. So, what happened? Well, let's take a look at SVB. As Silicon Valley venture capitalists, VCs, continue to support the tech startups, and particularly supported by the low interest rate economy and money printing by the Fed, Silicon Valley Bank was in a great place to capitalize on the expansion. When tech startups received the money they needed to support their growing organization, particularly while they're expanding but still making losses and spending money on development, they needed a place to store the cash. Well, this is where SVB, as we'll call it, had an advantage. It became the go-to institution for VC and tech startups. It's estimated that around half of all US startups had deposits in the bank during 2021. The startups were pointed at the bank by the VCs who knew it had a reputation for providing startup-friendly services. And what did SVB do with all this cash? Well, of course, as every bank does, it needs to keep enough cash and assets available to support daily and monthly withdrawals and deposits in the normal course of events. So what did it do with the cash it didn't need to meet this day-to-day demand? We'll get to that, but just an aside here on the nature of bonds. Bonds are at a simple level just loans that pay interest. They have a maturity date when the money is repaid back to the lender. Typically, when interest rates are low, short-term bonds, those that mature and pay back their investments usually inside a year, pay low interest rates. But if you are willing to lock your money up for longer, you can get higher interest rates. Therefore, demand for longer maturing bonds becomes higher, and so therefore the price of those bonds increases. So back to SVB, it saw that long-term bonds were going to be attractive to it for both the interest and the potential rise in value. At the end of the 2019 year, start of 2020, it had invested up to $80 billion of its assets in these long-term bonds, which paid a higher rate of interest whilst paying its own depositors a lower rate of interest. A great strategy, you might think. And for a while it might have worked, but think about having to repay those withdrawals. Now, when most of your assets are tied up in this way, i.e. in the long-term bonds, you're going to have to manage your remaining assets carefully so to have ready cash available to meet those demands. And this is where a combination of factors came together to undermine the bank's strategy. Firstly, in the wider economy, inflation, fueled to some extent by this inflow of cheap money, started to rear its ugly head. As a result, the Fed started to increase interest rates. So, newly issued bonds by the government and governments worldwide started to pay higher rates. These were therefore more attractive than the lower paying existing bonds whose price started to fall. Silicon Valley Bank was slow in reacting to this change in economic environment, and their risk management strategy was, to be fair, pretty damn poor in this respect anyway, and so they continued essentially as is for some time. By the end of 2021, they were sitting on around $15 billion of unrealised losses. And all of this shouldn't matter. If they could hold on to the bonds until they matured, they'd get their money back and these losses wouldn't materialise. However, at the same time, all of these VCs and startups needed access to the cash. As the economy made it difficult for the startups to get credit and equity, they started to withdraw their deposits in SVB to pay their own bills, utilities, payroll and the like. These withdrawals started to grow and the inevitable happened. SVB had to start to sell some of its long-term bonds to cover the demand, and in doing so crystallised these paper losses into real ones. Then we had the bombshell announcement. On March the 8th, the bank told the world that they had decided to sell their whole bond portfolio, at the time around $21 billion. All the losses would crystallise at once, and $1.8 billion of those losses were realised on that day. To deal with this loss, management at the same time tried to cover them by raising capital. All logical perhaps, but not exactly the kind of news investors like to hear. In another oh dear moment, a couple of days before this, Silvergate, a relatively small bank, failed. It had similar issues as SVB, but it also had its own exposure in the crypto market and the fallout surrounding FTX collapse of last year. Analysts, however, saw the issues Silvergate had with its bonds and rising interest rates, and well, the analogy with SVB was clear. What happened then was purely and simply a bank run. Fears for the losses being incurred by SVB meant customers withdrawing their funds at increasing rates. By the 10th of March, their attempt to raise more capital had failed and they were looking for someone to bail them out. As we know, all these last-ditch efforts failed. In 2 days, the bank had gone from what was a painful and difficult time to a catastrophe. Let's take a look at some of the areas that you might think, in hindsight at least, should be cause for concern, and not after the event but before, when everyone had time to plan for a scenario like this. Risk management. A big department in nearly all banks these days is the risk management department. So could the bank have foreseen the problems that were about to befall it? Well, possibly. Banks with risk management departments plan for scenarios like this. In fact, the regulatory authorities require them to model differing economic scenarios and what this might mean for their capital bases. Essentially, the bank should have enough core capital equity, which is often referred to as Tier 1 capital, to absorb the worst case and very unlikely events. Unfortunately for SVB, and this is where the question of management culpability are currently focusing, it didn't have a risk manager. The so-called Chief Risk Officer left in April 2022 and was only replaced in January 2023, just a few weeks before the collapse. The senior management team. The CEO at the time of SVB, Greg Becker, has been heavily criticised for his role in the bank's demise. His openness about the troubles the bank was in before trying to raise capital to help it through its problems are seen by many to be a significant part of the sudden collapse. According to one employee, that was absolutely idiotic, and that employee went on to say, they were being very transparent. It's the exact opposite of what you'd normally see in a scandal, but their transparency and forthrightness did them in. Where is Greg Becker now? Well, he was promptly dispatched after the failure. Rumours quashed. One rumour that has spread around the viral world, and that I initially thought was true as well, was that the CFO at SVB was the same CFO of Lehman Brothers when it collapsed in 2008. Well, this might make for a juicy revelation and oh my god, you're not going to believe this moment, but it's actually wrong, and I did fact check this, and the facts I found are that the Chief Administrative Officer of SV Securities, which is not the same entity as SVB, they happen to be owned by the same company though, and that's as close as it gets. His name is Joseph Gentile. Now, Joseph Gentile was at one point the CFO of a division of Lehman Brothers, but he had actually left that about a year or so before Lehman went under anyway. So there is an element of coincidence here, but it is not really relevant. Don't believe everything you read. I did fact check it, like I said. Timing of share sales and payments. Well, there were a couple of payments and share sales that took place, and you might say it was unfortunate, you might say there was some insider thought process going into them. You make up your own mind. So apparently payments to employees apparently went well, with bonuses from $12,000 to $14,000 made just hours before the collapse. And sales in stocks in the lead up to the collapse. In fact, in the weeks leading up to the collapse, apparently the CEO, CFO, CMO between them sold around $4.4 million worth of the company stocks. Now, the SEC filing does say that this was automated and pre-planned, so no doubt just a coincidence. Contagion. Stocks of the First Bank, Republic, Western Alliance, Bancorp and Westpac Bancorp and some other regional banks have all seen large declines, some as much as 60 to 70% of value in a day. Many hedge funds have also started to short sell the smaller banks, and they're perceived to be in a similar situation to SVB. Trading in these banks has had to be halted on a number of occasions, so could this contagion spread, and are we heading for another 2008? We'll say a bit more about this later, but I don't think so. The larger banks at this stage are not really under the spotlight. Their portfolio of investments is much more diverse than these smaller banks, and even SVB, who concentrated so much in the long-term bond market. You have to remember also that part of the big issue for the big banks in 2008 was their leverage, and the fact that a small downward movement in certain asset class prices would lead to a much larger movement downwards in the bank's asset base. And really, this isn't a comparison you can make today with SVB. In fact, bigger banks, I think, may benefit from either picking up assets from failed regional banks at cents in the dollar, or see benefits as depositors move their cash to the larger banks through perceptions of greater security. A bailout. SVB was the second largest bank failure in US history since the Lehman Brothers. The Fed, buckling under the pressure not to allow the contagion to spread, announced that depositors of SVB and Signature Bank are going to be made whole and have kept the bank running. Now, looking at SVB's website today, you can see this banner at the top. Silicon Valley Bridge Bank NA is newly created full-service FDIC operated bridge bank. The bank is open for business, and new and existing depositors have full access to their money and protection for their deposits. Moral hazard. This bailout leads to another issue, and that is one of moral hazard. What is that, you may well ask? Well, you see, what risk did the depositors' customers take when they put their money in SVB? Well, despite the lack of risk management, questionable management, share trades and exposure to the impact of inflation and interest rate increases, you could argue zero. If the Fed via the FDIC is going to be the bank of last resort to a bank this size, then what's the incentive to focus on worst case scenario planning and avoidance, when you know that the worst case scenario is just a fictitious theory, because ultimately the Fed is a backstop to failure? As a customer, why bother worrying about where you put your money, because there is no risk. The Fed will bail out the company if it gets into trouble. Now, the worst scenario, or the worst thing about moral hazard, is that companies in general start to downplay the seriousness of risk management, because, well, the perception that ultimately there is no risk, if I'm thought as being too big to fail, why bother with a risk management sort of thought process, could lead to the situation where a failure of one element of this then precarious pack of cards could lead to a domino effect, and this seriously then is too big for the government to bail out, and a truly monstrous recession ensues. So what now? Well, to all intents and purposes, the FDIC are running the bank, and SVB, well, it's now called the Silicon Valley Bridge Bank, NA, as we've seen. One of the key benefits of having the FDIC backing is that the bank itself will be protected from having to sell those long-term bonds at a loss and can wait for them to mature. And it seems that the chances that unsecured creditors of the bank, which essentially is those over with $250,000 deposits, get a large proportion of their money back, if not all of it, has risen significantly, if not become pretty much guaranteed. As it now says on the website, full access to their money. The FDIC said they will start to make repayments to uninsured creditors this week, although the terms are still unclear about that somewhat. But I think now things have been superseded. With the Fed now running the bank, they can just wait for depositors to withdraw their money as and when they see fit. However, as a depositor myself, I might think to myself, well, actually my money is now underwritten by the government, so it's possibly in about the safest place it could be right now. Just an aside thought there. So could there be contagion to larger banks? Unlikely. Whilst it is the 16th largest bank, or at least it was until recently, SVB is still quite small compared to the top of the pile, and for example it represents less than 1% of total banking sector assets. And the larger bank's diversity in portfolio of investments means they're not really exposed to the same levels of risk as SVB. I think the issue in the marketplace at the moment is twofold. First of all, there will be the continuing impact of the collapse of FTX and some of the cryptocurrencies from last year that has continued into this year, for example with the collapse of Signature. And we still have this inherent bond risk that a number of banks are carrying themselves, although perhaps not to the extent of SVB and perhaps not as large as SVB. I think we might see one or two banks coming under some pressure in the forthcoming weeks as well. With that having been said, I can't predict the future. Ask me in a couple of months and I'll tell you exactly what's happened. I hope you've enjoyed this update. I will possibly take a more focused look on some of the people and the management involved in some of these. I think here we have a case of bad management rather than fraud or corrupt practices, which is really more of the focus of this channel. And of course, where we have an overlap with the FTX collapse and the fraud that Sam Bankman-Fried led, then clearly, oh, did I just say that? I meant allegedly led. Then the knock-on impact there is clearly of relevance to some of the videos I've already done on the FTX collapse. Please think about a subscription. Your participation would be truly appreciated. Thanks in advance. Bye for now.